Stocks clock some early gains and hold on to the green ahead of the weekend, and a truncated US session after Thanksgiving. Healthcare and utilities are prominent gainers, while realty drags mid-caps underperform.
Hindustan Unilever turns its focus on affluent agglomerations as part of its growth strategy that sees brands like Surf Excel, Dove and Ponds being in the sweet spot for premiumization.
A bunch of institutions and other shareholders of Zee Entertainment defeat a resolution to reappoint Puneet Goenka as director. Goenka, however, continues as CEO of the company. Stock cheers the news.
And Air India CEO Campbell Wilson says the airline's revival will be the Everest of corporate turnarounds, but seeks patience, says the ambitious plan to upgrade legacy fleet will take more time and cost more than the budgeted $400 million. He claims that airfares have gone down amidst the consolidation in the sector. That is a CNBC-TV18 exclusive. Good afternoon. You're watching Halftime Report here on CNBC-TV18 on the final trading day of the week. I'm Hormus Fatakia. With me, as always, is Mangalam Malu. Mangalam, good afternoon. It's the good day for the Nifty, at least for now, considering courtesy Reliance Industries and ICICI Bank. The same can't be said, though, for the Nifty Bank. The index is off the highs of the day, slipped into the red, as have the broader markets today. But there is a lot to look forward to going into the weekend.
Lot to look forward to going into the weekend. I don't know whether it's market related or personal related, but weekend related. As far as just the markets are concerned, portfolios may not be feeling very good today because we have the advanced decline lines coming out very close to each other for the weekend as well. We have almost each stock declining for the stocks which are advancing, so there has been a bit of an intersection. How the second half plays out will be very crucial because the Nifty Bank is now below the 50-day moving average. Today, its first excursion to the 50-day moving average was defended. The Nifty Bank moved above from that and now has moved to the low point of trade. And what kind of bearing it has on the Nifty itself is something we'll watch out for. But speaking about the banking sector itself, and in that the financial space, microfinance sector, that's in focus on the back of fresh brokerage commentaries coming in, which are cautious on the sector. Abhishek joins in with the details of that one. Abhishek.
Well, brokerages have turned cautious on the microfinance sector. Remember that CNBC-TV18 had alerted viewers about the rise in stress in microfinance sector 6 months ago. So UBS has written on microfinance. They say that, overdues in October continued to see an upward trajectory with PAR, that is portfolio at risk of 0 days and above, has risen by 130 basis point month on month to about 17.5%. So they expect slippages of formation of bad loans to be higher in H2 FY25. The MFI industry portfolio outstanding is down 8% from March to October. So loan growth momentum is also slowing down over there. Jefferies has written on MFI sector. Again, they are saying that MFI loans of 16 lenders who form 60% of the industry points at 18% CAGR in 2 years with rise in customers as well as exposures. So loan growth may fall in H2 FY25. Leverage is up with rise in share of more than or equal to 4 loans per customer. That has risen from 4% of the portfolio to 6% in the last 2 years, and which forms about 19% of the overall industry loans, and that is leading to higher overdues. So Utkarsh as well as Spandana and Credit have higher share of customers who are leveraged on the higher side, that is more than 4 dues per customer, while Bandhan Bank actually can fare better as per them. Now Goldman Sachs has also written on MFI sector. They say that the stress pool could be around $4 billion to about $18 billion is the potential stress pool that they have identified. So loss rates in MFI segment have worsened over the last 2 quarters. They believe that the sector will continue to face headwinds and could see a further spike in loan losses in H2 FY25. So they have baked in 12% to 17% of the loan losses from these stress pool that they have pointed out. Back to you.
Thanks a lot for that, Abhishek. It's showing up in the stock price, particularly in Credit Access Grameen after that big downgrade that came in from Goldman Sachs this morning. It has 60% cut in its price target for Credit Access Grameen now to 564. from 1400 levels plus earlier. But moving on, then the other one is the stock in focus is Allied Blenders, and that is because of a brokerage report from ICICI Securities. And Mangalam, it's become a trend, right? Talking about all these distillery companies and being teetotalers, and that too on a Friday.
That too on a Friday. You know, we're talking about these companies while we have our glasses of water when we talk about this. Yesterday was Tilak Nagar Industries, where we gave you an insight edge into what the management had to say. Today, Allied Blenders is holding up with about 2% in terms of gains at a time when the mid-cap index is actually underperforming. ICICI Securities has gone ahead and initiated coverage on the stock with a target price of 400 odd rupees. What is it that they're expecting? They're expecting just about 10% in terms of revenue CAGR over the next 3 years, but EBITDA actually grows at around 30% compounding for next 3 years. Why is that? Because one, they believe that this company is well positioned to capture premiumization trend in the alcohol beverages industry. Remember, this is a word that a lot of these alcohol bev companies are talking about. They have a brand called the Iconic White Whiskey. They expect the volume contribution of that to double in FY25, and growth will come by in the next few years as well. And their mass premium whiskey, which is Officer's Choice, which is a fair amount of market share in that segment itself, they will be a lot more profitable if they improve the state brand mix. So there are some states which give you better realizations, some states which don't give you better realizations. So mixing that or adjusting that mix could actually, lead to improvement. But the biggest improvement will come in from backward integration, where they expect, margins to improve by almost 170 basis points over the next couple of years, where ENA, which is an important raw material, which was earlier outsourced, will now be entirely made in-house by the company itself. And that's something that the management has been telling us on CNBC-TV18 as well. What are the key risks to their call? No different from the risks that would be for any other alcohol company. Potential ban or regulatory change in key states, and failure in scale-up of prestige and above segment. Typically, for a brand that is known, a company that is known for a brand like Officer's Choice, which is mass premium, going above for every brand in terms of positioning becomes a lot more difficult, as we've seen with a lot of the other consumer companies as well, which try to premiumize on the same brand. So that's something we'll watch out for.
Interesting. The stock remains above its IPO price, though, of 281, still trading with gains of around 2%, although off the highs of the day is Allied Blenders. But moving on then, a bunch of institutions and other shareholders of Zee Entertainment defeated a resolution to reappoint Puneet Goenka as its director. Vamakshi is joining in with more details on that. Vamakshi.
Well, Hormaz, yes, that's right. The shareholders rejected a proposal to reappoint Puneet Goenka as the director of the company in its AGM that was held on November 28th. This proposal was defeated by a 50.4% vote. Now, keep in mind that earlier on, there were some proxy advisors like InGovern as well as IIAS. Both of these proxy advisory firms had actually recommended the shareholders to, to vote against his reappointment. And a few days ago, in fact, Puneet Goenka had already stepped down as the managing director of the company. He said that he wanted to concentrate on his operational responsibilities as the CEO of the company. So therefore, materially, largely nothing changes for Puneet Goenka as a whole, because he will still continue to run the company as the CEO. So that is the news flow around Zee. As of now, the stock is up in trade.
Stock is up in trade, almost 5% higher is Zee Entertainment. Puneet Goenka remains as the CEO of the company. Time for a short break. Up next, the management of Electronic Marts India joins in to discuss the business momentum going ahead. Stay tuned, we'll be right back.
Welcome back. As promised, let's get chatting with the management of Electronic Marts India. Electronic Mart, the stock currently under a wee bit of pressure, but no real worries. It was a big mover in yesterday's trading session, and a large part of that could be attributed to the Edelweiss note, or erstwhile Edelweiss, now Nuvama note, that came in, initiating coverage on the stock with a target price of 237, indicating an upside of nearly 36-37% from current levels itself, where they expect the robust cash flow coming in from Telangana to support expansion into NCR. And that exactly has been the story that we've been discussing with the management of the company in the past few interactions that we've had as well, expanding into NCR itself. Premchand Devarakonda, who's the Chief Financial Officer at Electronic Smart India, now joins us. Thanks a lot, Mr. Devarakonda, for joining in. We've had this conversation about you expanding your presence into NCR, increasing your per store revenue out there as well. But, for now, just wanted to understand how the third quarter has been for you, largely because, one, it is a significant chunk of your revenues that comes in, festive season, etc. And secondly, we've also seen, post-Andhra elections, has there been any sort of optimism? What can we expect in the second half of this year?
First of all, thank you for having me on your show. This festive season is quite promising. So there has been a double-digit growth as compared to last year. So season to season. And also this quarter is on the track. We have seen decent growth coming in from the clusters like Andhra Pradesh and rest of Telangana. Since in Hyderabad, if you look at Hyderabad as a cluster, so since the base is very high, so the growth is in single digit, whereas in other clusters, the growth has been quite significant. That means it was more than 20% during the festive period, that means 1 month period. And in fact, Delhi is also on the growth path. So there we could see more than 40% growth during the festive period.
Mr. Devarakonda, good afternoon. Thank you for joining in. Since you mentioned this, now how do you expect the second half of the year to be? Because your first half saw your same-store sales growth at 6%, revenue growth at 13%. Do you expect to remain on a similar trajectory, considering the fact that the third quarter accounts for a larger chunk of the revenue along with the first quarter? So do you expect to do better numbers than what you did in the first half or along similar lines?
It will be more or less in the similar lines. And also it is subject to that summer setting in. Like normally in the clusters in Hyderabad and Telangana, Andhra Pradesh clusters. So if summer starts sometime in the second half of the March, so definitely there will be much better growth we are expecting. But if summer is delayed, it will be more or less in the same lines like the first half year.
It'll be very interesting to, find out what kind of sales you are seeing in New Delhi, especially when it comes to air purifiers, given the sort of AQI that there is there. But, from a sustainable revenue, EBITDA and net profit growth parameters, what is it that one should work with? Because, this note that I'm alluding to coming in from Nuvama, they expect revenue compounding of over 21% for the next 3 years. The first half of this year, your revenue growth has been just around 13%. You expect the second half to be similar to the first half itself. So obviously this revenue growth will be back-ended. Do you think this 21% growth is sustainable and achievable? And if you can break that down, how much of that will come in via SSSG and how much of that will come in via new store addition?
See, our target is actually, let us be conservative. So we are expecting around 15% year-on-year top-line growth. So out of which about 6 to 8% will be coming in from as a same-store growth. Because we opened almost 60 stores in the last couple of years, which are maturing currently, and there is decent growth coming in from those stores. So that's why the blended at the company level, the SSG will be around 6 to 8%, and overall top line growth will be around 15%.
That is for this year. And the next couple of years?
Yeah, that is going to be the scenario. So if Delhi, that cluster does exceedingly well, so it might improve by another 3 percentage points. That means it might go up to 18%. So that is our target, like between 15 and 18%.
What is your target for adding more stores this time around, Mr. Devarakonda, in the second half of the year? And maybe if you could share a number for the next year as well. And how do you plan on doing that when it comes to geographical diversity? You want to do it more in metros? You want to do it more in tier 2 cities? And how do you plan on doing it? More company-owned stores, or do you even aspire to do the franchise route as well?
First of all, we are not looking at franchising model. That is ruled out. Coming to that store addition, So before end of this financial year, we will be adding at least 12 to 15 stores, out of which about 6 stores will be in Delhi cluster, and the remaining will be the existing clusters. That means AP Telangana. In AP Telangana, now we are looking at the tier 3 and 4 cities as well. So there we have a lot of scope for, there is a decent market, as well as we can see decent, economy is also growing in those smaller towns. So because they're predominantly agriculture dependent places. So that's why out of 10 to 12 stores which are going to be added this year, 6 will be in metro, and the remaining will be in the tier 3 and 4 cities. And for the next year, we are targeting another 25 stores, of which about 6 to 8 stores will be in NCR, and the balance will be in the existing clusters. And we have been exploring the other markets, so peripherals of Delhi, like Western UP, Haryana, Punjab, and and our teams are aggressively working and gathering the market information. So maybe we will take a call in the first quarter of the next year. So to expand our operations beyond NCR and AP Telangana.
All right, then before we let you go, one final question, and this is a two-part question. One is on NCR itself. You had earlier said that you are expecting NCR to scale up to the same metrics when it comes to revenues as South India. I wanted to know, where does that number stand at right now, and by when do you expect NCR, at least on a revenue front, to be similar to the South? And the second part is margins, because NCR is a lot more competitive. Obviously, the margins in NCR will be a lot lower than what it is in the South. And increasingly, your revenue share from smaller appliances, mobiles, etc., low margin products is increasing as well. So what is a sustainable margin target that one should look at? Two-part question, one on NCR scaling up, secondly, sustainable margins.
Yeah. NCR definitely on the growth path. So there has been year-on-year 50% growth. Not exactly 50%, it is about 45% till now. And the same trend would continue next year also. So because we are planning the new stores which are coming up in the bigger markets in NCR. So we are expecting at least, the trend would continue in the next year also, around 40% growth coming in from the NCR. Coming to the economies of scale, definitely NCR is little expensive as compared to the South cluster, but we were prepared for it. So the blend, we always look at the company level blended EBITDA, which should be maintained around above 7%. So that could be, as long as we achieve that, so we are comfortably positioned. So if you look at NCR as standalone business, so there the EBITDA levels will be little lesser. This year it might be around 4-5%. So I'm a little optimistic. So if it is above 4, we are comfortably positioned in NCR. And there is definitely NCR is, since it is a bigger market, like the market size is twice the size of Hyderabad. So if the store throughput improves, like if it comes, if it reaches the level as we have been operating in Hyderabad cluster, which is on an average, we are getting about 70 crores throughput per store. So once we reach that level, NCR will be on par with the rest of the clusters.
All right, Mr. Devarakonda, thank you so much for sparing time, joining us to talk about your road ahead as well. Wish you good luck for the second half of the year. The street likes what you said, because the stock has moved into the green as the conversation went around from the lows of the day, currently at 180. Time for a short break. Up next, Ashish Kyal of Wave Strategy Advisors joins in with some trading strategies and a chart check on the market. Stay tuned, we'll be right back.
Welcome back. It's a strong start to the December series as far as the Nifty as well as, the mid-cap, Nifty as well as Sensex is concerned. The front cap indices is what I'm talking about. The Nifty is actually led well by the IT index as well as Reliance. So if you look at, the strong start for the series plate that comes up for you on the screen, you have the Nifty IT index, Reliance, both of them supporting the cause of the frontline index. What's not supporting the cause of the frontline index is Nifty Bank, so is the mid-cap index. So the mid-cap index has been underperforming, as is the Nifty Bank. The Nifty Bank is very close to the 50-day moving average, so that's something we'll keep an eye out on. For the Nifty itself, just below 24,000 is strong support coming in the form of the 20-day moving average. Too early in the series to talk about, levels, what option writers are positioning themselves for. But it's the start of a new series and a lot of new F&O entrants. 45 stocks. We have Adani Green, APL Apollo, BSC, a good outing on day one of their F&O. Whereas on the other side, obverse side, we have a decline coming in for Delivery as well as Zomato. Both those stocks under pressure as they enter the F&O space as well. The key triggers for December series will be the RBI policy outcome on December 6th. Geopolitical news and global news is something we'll watch out for. Low global liquidity in holiday season typically leads to a big move in the second half of December, which a phenomena a lot of people call as the Santa Claus rally. Whether that comes by this time or not is something we'll watch out for.
They would definitely expect some Santa Claus rally to come in towards the end of the year. Manglam, thanks for that. We'll get some more chart checks on the market then. Ashish Khyal of Wave Strategy Advisors is joining in. Ashish, good afternoon. Thank you for joining in. It's a good start, at least for the Nifty, for the new series. What do you do in such a scenario? You use this bounce to reduce positions, or do you add to them? What are the charts indicating? And couple that up with your stock recommendations as well for the afternoon.
Hi, afternoon to you and all the viewers. If you look at Nifty, yes, there has been a lot of volatility since yesterday. You can see that when Nifty crashed in just 5 minutes, nearly 5 to 8 minutes, by 200 points on the downside, reversed sharply on the upside, and there is lot of chaos. I think it has to digest this volatility. So expecting a range-bound movement right now over a broad period of around 24,350 on the upside, and on the downside 23,890. So that's the range in which Nifty can move. Having said that, over short term, I think it's a buy market right now over the near term. We can expect a bounce back from here towards the upper end of the range, which is 24,350. As long as on the downside, the support, which is around 23,980, which is an intraday low around that area, is intact. And also very interestingly, if you look at the derivatives data, 24,000 is showing very sharp rise on the put side, which is indicating that there is the conviction back into the market where the put sellers are getting active at 24,000 levels. And that's a little positive and comforting sign. So I think we might be seeing a upside thrust in the second half, and toward the level of 24,250, 300 levels. Having said that, the first stock pick on the buy side is going to be FACT, Fertilizers and Chemicals Travancore Limited. We can clearly see a very strong move in today's session. The chemical stock, the fertilizer stocks since yesterday are doing exceptionally well. And this stock is breaking out after quite some time. We can expect it to move towards the level of around 1,020 on the upside. And one can maintain a stop loss of 900 on the downside. The next stock pick is going to be CAMS. We can see CAMS is trading at 52-week high. The stock has bucked the trend. There is absolutely positive candles past 4 days consecutively, and the overall trend remains bullish. Any dips can be used as a buying opportunity for the target of 5380 on the upside, and we can maintain a stop loss of 4840 on the downside.
All right, CAMS is another of those 45 names which have entered the F&O space today. Ashish, thank you so much for joining in. Would have loved your views on Reliance, but we'll leave that for another day, largely because we're out of time. Speak to you very soon. Let's slip into a short break. On the other side, we get you the preview of India's second quarter GDP number. What is the street expecting this time around? We'll tell you.
Back with us here on Halftime Report. Now the second quarter GDP numbers are due later this evening at 4 p.m. Lata is now joining in with the key expectations from these numbers. Lata, over to you.
Big number we await today at 4 p.m. is the second quarter GDP number. Our CNBC-TV18 poll sees Q2 GDP at 6.5%, and that's the lowest in 6 quarters. This 6.5% compares with 6.7% in just the previous Q1 and 8.1% year ago in Q2. The Reserve Bank itself has forecast 6.8% growth for Q2, the quarter that ended on September 30th. But that is down from its earlier forecast of 7%. Now, our poll also sees the GVA, gross value added, at 6.5%, same as GDP, versus 6.8% Q1 and 7.7% year ago. The GVA actually is a better measure of the economy. GVA, you just have to add taxes, subtract subsidies to get to the GDP. Now, as per our poll, GDP is dragged down partly by poor showing of manufacturing and electricity. However, services are expected to have done well at 8.2%. Let's see. Looking at GDP from the expenditure side, the fear is that government capex, or gross fixed capital formation as it's called, which was doing well till about a quarter ago, may have slumped in Q2. Our poll also shows that some economists, including the Reserve Bank, see a very smart rebound in the second half. That's the CNBC-TV18 poll, expecting 6.8 to 7% growth in the second half, Q3 and Q4. The Reserve Bank itself expecting 7.4, but not all people in the poll are agreeable to even 6.8 to 7%. So that 7% plus growth, which the Reserve Bank is forecasting, doesn't have too many supporters now. So have we given up the 7% growth pace altogether, which we had over the last 3 years? That we will know only in May of 2025, next May.
Right, Lata, thanks a lot for that. We'll keep an eye out on all the developments out there. Take a short break. On the other side, we get you also the key expectations coming in from the November auto sales months that are due next week. And that's an important one because the GDP is a lag indicator, the auto sales a lead indicator. Welcome back. Let's talk about the auto sales that are due next week. November auto sales, which are due next week, tells you that the overall demand picture will be fairly mixed. Volume growth will be impacted by the earlier timing of the festive season this time around. So Darshan joins in with all the details. Darshan obviously gave us a peek into how sales were through the retail Vahan data, but wholesale data is what the companies record as well, and he's going to tell us more about that. Sudarshan.
That's correct. So wholesale growth for the month of November is expected to be mixed, while rural demand is going to support the growth, but slowing urban demand and higher base may keep that growth in the check. Also, volume growth is likely to be impacted by earlier timing of festive season this year. Starting with two-wheelers, service indicates slowing demand trends, and on year-on-year, growth is seen somewhere in the range of 2 to 6%, while month-on-month, sales are expected to decline up to 30%. But as far as Vahan registration data is concerned, for the month of November, growth is seen healthy, and it's likely to come somewhere in the range of 19 to 20%. For passenger vehicle segment, here, weak demand conditions continue to persist. We are seeing higher discounts even after the festive season sales and inventory reduction. As far as Vahan registration data is concerned for this segment, retail sales will likely decline 14% YOY, but for the wholesales, which will be impacted by the higher base of November 2023, we may see an average growth of 6 to 7% YOY, but month on month, there can be a decline up to 15%. For commercial vehicle, this segment is expected to be supported by a low base, and analysts are expecting here a gradual recovery with an increased government spend in H2 FY25. Wholesales for this segment may see a minor growth YOY, but on month-on-month may see a decline in the range of 5 to 10%. For this segment, Vahan registration data is expected to decline 7%. Last is tractor. This segment is going to be supported by 4 to 5 factors. First, good rainfall. Second, good reservoir levels. Third, crop prices. And fourth is improved rural sentiment. And on the back of all these factors, this segment is seen rising 5% year on year. So overall, we are expected to see a mixed picture. But historically, if we talk about immediate month after the festive season, it has always been weak for this sector.
Keep an eye out on all important auto sales numbers. Sudarshan, thanks a lot for that estimate. Now, time for a short break. On the other side, Manisha Gupta joins in with Atul Ganatra, the president of the Cotton Association of India. Stay tuned.
Welcome back. Joining us on the show now is Atul Ganatra. He is president at Cotton Association of India. Mr. Ganatra, thank you for joining us. First things first, and we hear that the government has cut the cotton output numbers by nearly 9% as compared to the previous year. What are the CAI numbers, and do they match with what the government numbers are?
Good afternoon, Manisha ji. Yes, yesterday's meeting of COCPC, government agency, they have cut the production of 9% from last year's 326 lakh bales to 299 lakh bales. And CI figure is very near to that, around 302 lakh bales. The main reason for cutting down the production was the sowing is reduced 10 lakh hectare, that is from the 327 lakh hectare of last year versus this year 313 lakh hectare. This was the main reason. Cotton farmers are shifting to other crops since the return in the cotton, sowing in the cotton is compared to other crop is lower side. Yes, Manisha ji.
Mr. Ganatra, also, how has been the demand in the light of this? Because we haven't seen the prices run up too much, even as the crop is seen slightly on the lower side. How has been the textile industry demand?
Yeah, in fact, even though production numbers are lower, Indian prices, cotton prices has been reduced from 62,000 2 months back to today 55,000 rupees. And this is very good for the textile mills. And most of the textile mills, spinning mills are making good profit from last 2 months since the raw cotton, raw material prices has been reduced, and it is a very good demand is picked up, and the time for the textile mills are, they now stop making losses and they are now in profit. So good time for textile, Manisha ji.
Oh, absolutely. So what is the kind of demand that the Indian textile mills are looking at right now? You've told us that this is profitable because the raw material prices have come down. But is the demand for cotton on the higher side? Are the textile mills asking for a lot of cotton?
Yeah, textile mills are asking a lot of cotton. In fact, even in export to our neighbor countries like Bangladesh, demand is picked up, and every day around 8 to 10,000 bales are exported to Bangladesh. Even local mills want to buy more cotton, but the daily arrival is around 2 lakh bales. And since the prices are lower side, CCI is buying 1.25, 1.4 lakh bales daily on MSP prices. So mills are not getting enough cotton, what they want, because cotton is going to CCI. But CCI is helping to the mills, and they have reduced the last year's cotton prices to 55,000. And in last 1 week, around 4 lakh bales of CCI has been sold to the mills. So this is very good price for mills also to buy cotton from the CCI. And also CCI is giving 2 months, 60 days time to lift the bales.
Okay. Mr. Ganatra, also, as we go ahead, we do understand that India doesn't produce all types of cotton. So there is some cotton categories that are imported as well. With 11% of import duty, how is that working?
Yeah. See, we need actually extra long staple, which is not available more in India in the quantity what our mills required. So definitely, but government has given a relief for the duty. If around 3 lakh bales of Australian cotton is available on duty free, and also they have given certain benefit on extra long staple if they are importing, there is a lot of concession in the duties available. Also, the mills who are doing export, they are also allowed to pay only 50% duty. So duty is 11%. Against export of yarn and material, they can buy the cotton on only 4% duty. So it is called against advance license. So there are a lot of relief to the mills, but anyhow mills are asking more relief and to remove the duty. But we have given from CI, we have given a proposal to government from 1st October to 30th March. This 6 months is a arrival time in India, and farmers are selling 90% of the cotton. So 6 months you may keep duty of 11%, and second half when the farmer sold 90% of their crop, and there will be no loss if government is reducing from 1st April to 30th September, if they are reducing or removing the duty, it will be very good for the mills. So no loss. It is a win-win situation to both farmer and the textile.
All right. We do hope that the government does listen to that and categorizes the duty in two different parts as per the year there. But Mr. Ganatra, thank you so much for joining us, giving us a sense on what the textile demand seems to be at this point in time. But with that, that's all the time that we have on the show. Well, we'll come back and Business Lunch will take all the action ahead.